Hi, and it's the last week of March. If you've done nothing about your income taxes for this year, you still have a couple of weeks to go. And if income taxes are bugging you, you're in great company because even Albert Einstein said that income taxes are one of the most difficult things to understand. So you're in great company, and it doesn't have to be that way. We could understand some very, very basics about income tax in this 101. And over the next 4 or 5 videos, I'll take you through some essential concepts that you have to understand about income tax to even have a reasonable conversation with your chartered accountant. Okay, so one of the biggest things about income tax is understanding how much tax you will pay. Many people come and say, I have to pay 30% tax, and I don't want any tax at all happening on my account, right? So let's understand how much taxes you will actually pay, because in India, we follow a tax slab system. If your income increases, then you pay more taxes as a percentage of your income. So we'll just look at it this way. It'll be easier for you to understand. So I'm sorry to confuse you with the old tax regime and the new tax regime. From the next year onwards, we won't talk about these things. But this year, let's understand. For the first 2.5 lakhs of your income, you don't pay any tax at all. Okay, so it comes under nil taxes. If your income increases, or if your income crosses the 2.5 lakh limit and up to 5 lakh rupees, you pay a 5% tax. So that's approximately 12,500 rupees of tax, which again, you can claim a tax rebate under Section 87A that is available. So which means up to 5 lakhs, you almost pay no tax at all. If your total income for the whole year is less than 5 lakhs, there is no tax payable at all. Now, when income increases from 5 lakhs to 7.5 lakhs, then, or 7.5 lakhs to 10 lakhs, 5 lakhs to 10 lakhs, in the old tax regime, you pay a 20% tax, and in the new tax regime, you pay about 10 to 15% tax. The moment your income crosses 10 lakhs, then you move to the 30% tax bracket in the old tax regime. And in the new tax regime, up to 15 lakhs, you still pay 20% and 25% tax. And once your income crosses 15 lakhs, then you get into the 30% tax slab. What you have to understand between the old tax regime and the new tax regime is, in the old tax regime, you could claim a lot of deductions and exemptions. Almost 40 exemptions are available for you to claim, which we're going to be talking about in the rest of the videos in detail. And in the new tax regime, you don't have to, if you're choosing new tax regime, you don't have to watch any more videos. You just go by this, and there are no more exemptions or deductions that you can claim. You just get a lesser tax impact on your incomes, right? Then after all of these slab wise taxes, there is also a surcharge that you'll pay if you are earning more than 50 lakhs or 1 crore or 2 crore or 5 crore. So you are taxed more as your income increases. It crosses certain thresholds, right? And almost all of us pay a 44% of surcharge or educational cess, which is a 4% on your income tax plus surcharge. Okay, so you probably understand this better if I show you with an example. So just look at it this way. In case your income is 20 lakhs, going by the same slab system, for the first 2.5 lakhs, you don't pay any taxes at all. For the next 2.5 to 5 lakhs, you pay 12,500 rupees tax. And 5 lakhs to 7.5 lakhs, you pay 50,000 tax. And 10 lakhs to 15 lakhs. So once you cross 10 lakhs, then you move on to the 30% tax. So in the old tax regime and the new tax regime, your tax liability in the old tax regime would come to about 4.12 lakhs if you have not used any of your exemptions and deductions that are available to you. And in the new tax regime, instead of being 4.12, it'd be 3.42. So you don't have to do any investments or buy any insurances or anything. You just get to pay much lesser taxes. And of course, there's no surcharge when your income is only 20 lakhs, but you'll pay a 4% education cess. So the total tax liability will be about 4.29 lakhs if your income is 20 lakhs, and 3.56 lakhs in the new tax regime if your income is 20 lakhs, which means your effective tax rate is anywhere between 17.8% to 21.45%. It's not 30%. Okay. Now this changes as your income increases, as you know. In case your income is 60 lakhs, then let's look at how much tax you'll end up paying. So At 60 lakhs, of course, for the first 2.5 lakhs, you don't pay any taxes. And then if you move into the TAPS slab system, you pay 5%, 10%, 15%, 20%, 30% taxes. And your tax liability will work out along with surcharge and education cess to approximately 16.83 lakhs in the old tax regime and 16.1 lakh in the new tax regime, right? So the effective tax rate here would work out to be anywhere between 26 to 28%. So it is as your income increases that you will be touching your 30%, the actual effective tax rate of 30%. So if your income is less than 20, 30 lakhs, you don't have to worry about saying the 30% tax I have to pay on all my income and stuff like that, right? So this is clear. I just want you to leave with one word. The tax is not a four-letter word. It is the price we pay for the country we want. So paying taxes is your responsibility. Having said that, you also have the right to save taxes, which we will look for in the next video. Okay, before we start talking about how to save taxes, this is an important 101 basic knowledge that you should understand, that depending on where your money comes from, the tax rules differ. Okay, different income sources, different tax rules. Okay, so you'll probably understand this better when we explain it this way. So you could have income coming from agriculture, or you could have income coming from a salary. You could have income coming from running a business or a profession. You could have income coming from properties that you own, residential or commercial or farmland properties that you own. Or you could have income coming from the sale of capital assets or income from capital assets in case you have a property or jewelry or shares or patents. They are called capital assets, and when you sell them, if you make a gain, they are taxed in a certain manner. And you could have other income. They could be gifts, or they could be earnings from lotteries, or it could be just interest that you earn from your bank, right? So these are income from other sources. So we saw 5 different sources of income, and each of these sources are taxed differently. It's very important for us to understand that. Right? How is agricultural income taxed? Agricultural income is exempt from income tax. In India, as on date, it's exempt from income tax. How is salary income taxed? Salary income is, of course, taxed as per slabs mentioned earlier. Your first 2.5 lakhs is tax free, and then it's 5%, 10%, 20%, 30%, right? So, as per the tax slab, your income tax is taxed. You can't incur a loss under this head, but you can get some adjustments as standard deduction and a few other exemptions that you can get in HRA and stuff. How is business income taxed? Business income is, of course, taxed as per slabs mentioned, but expenses incurred to run the business can be adjusted against the income earned, which you can't do with your salary income. There is a standard deduction which you can deduct, but expenses incurred to run the business can be adjusted against income earned from business. So you can typically incur a loss in business income, and this loss can be set off against other income except salary income. So if you have also a salary income coming in and also a business income coming in. Let's say you also get an interest income or you get rental income. If you incur a loss in your business, you can set it off against your rental income or your interest income, but not against your salary income. How is the house property income taxed? It's, of course, as per tax slab, but expenses incurred for maintenance, taxes, interest on loan can be adjusted. And you can incur a loss here again, because in case you're paying more interest than the rent you earn, then that's considered a loss in, from income from house property. It can be set off against any income. It can be even set off against your salary income. Our capital assets taxed, they are taxed at a very special rate. Indian equity-based assets, if you have shares or mutual funds, then they are taxed in a manner which is 15% if the gains are realized within 1 year, or 10% if realized after 1 year. So for example, if you're investing a lakh of rupees and you hold those investments for 2 years or 3 years, and the lakh of rupees becomes 1.5 lakh rupees, and if you book those profits at the end of 3 years, the 50,000 rupees profit that you have booked will be taxed at the rate of 10%. If you book the same profit within 1 year, you'll be taxed at the rate of 15%. If they are non-equity based assets, then they will be taxed as per slab rate if realized within 3 years, or 20% adjusted for indexation if it's more than 3 years. basically understand that capital assets are taxed specially, and to calculate capital gains taxes, do refer to your chart accountant. Huh. So one important thing that you should understand is, yes, you can incur a loss with sale of a capital asset and you can set it off. Of course, with share markets or with even selling property, you can incur a loss. So if there is a short-term capital loss, so if it is equity, short-term is considered 1 year. If it's anything apart from equity, short-term is considered 3 years. So if it is short-term capital loss, you can set it off against short-term or long-term capital gains. So if you make a loss from sale of a property within 3 years, you can set it off against all other income that you've gained, all other capital gains that you've made in the year, which means effectively you can reduce your tax impact. But if you have a long-term capital loss, you can only set it off against a long-term capital gain. You cannot set it off against a short-term capital gain. And losses can be carried forward and set off against gains over the next 8 years. So if you have a bad year in stocks or shares, there is a silver lining to it. You can carry forward those losses. And if you have a good year, the next year you book some profits, you can set it off against the bad year that you had, right? So that's not a bad deal after all. It's okay. How are other income taxed? So other income, of course, added to your slab rate. You can't incur a loss here, so there's no option for any set off or anything, right? So these are broadly the 5 tax sources, income sources, and they're all taxed slightly differently from each other. So money is money from wherever it comes, yes, but not for the tax man. Yeah. So in the next video, we'll talk about how you can save taxes. Okay, so what are important tax saving options that the government provides us? What are important tax saving options that are available to us? So let's just look at the most common tax saving sections. Of course, like I told you, there are about 40 odd deductions and exemptions that you can claim. But this is a 101, right? This is not a tax. You're not going to write a tax exam or something. So let's just go with the most common tax saving sections. The most common tax saving sections are covered under section 80, 80C, CCD, D, E, G. Okay, so we just go through these once. Section 80C is to encourage long-term saving habits. CCD is to encourage retirement saving habits. 80D is to promote purchasing of health insurance. 80E is to encourage spending for higher education. And 80G is to encourage you to contribute to social causes. So like I told you, that taxes are the price that we pay for the country that we want. These are all the options that the government gives us for behaving well, for building good habits, for contributing to take care of yourself and take care of the country, right? Okay. So under section 80C, long-term savings are supported. You can save up to 1.5 lakhs in these instruments and set it off against your income. So all your income. So you add up all your income, make these savings, reduce your income to the extent of 1.5 lakhs and pay tax only on the rest of the money. Right? You can invest in all of these options. We will look at them in more detail in the next videos. But just for your understanding, they include public provident funds, employee provident fund, life insurance premiums, equity-linked saving schemes, which are predominantly mutual funds, and the principal amount that you pay towards your home loan. In fact, the stamp duty and the registration charges that you incur at the time of purchase of a property also can be claimed under section 80C. Sukanya Samriddhi Yojana, then National Savings Certificate, Senior Citizens Savings Scheme, ULIP, tax saving fixed deposits for 5 years and infrastructure bonds. Also, to give you some benefit of paying tuition fees for your children. If the tuition fee you pay for your children is about 1.5 lakhs, you can make that claim. Even if it's lesser, you can make that claim. Okay, all of these, if you make all of them also, the total, it can be 3 lakhs, 5 lakhs, doesn't matter, but you will get a tax saving of 1 point. You can get a tax deduction of 1.5 lakhs, right? Next is the section 80 CCD, which is to promote retirement savings. You get an additional saving opportunity of about 50,000 rupees. So here the investment is primarily done in something called the National Pension Scheme. And here most salaried employees have this facility that the employer provides. So you have an employer contribution to the NPS, and then you have an employee contribution to NPS. So these are covered under various sections, section CCD2, section CCD1, and the self-contribution to NPS. So apart from what the employer mandatorily deducts and contributes, or what you do as part of your employment, you can, as a salaried employee also, as a self-employed person also, contribute voluntarily to NPS, and this is covered under section CCD 1B. The maximum deduction that's available for you is 50,000, and this is in addition to the ATC. Okay. So an additional 50,000 benefit is available for specific contribution to National Pension Scheme. What is the National Pension Scheme? This is an investment that you make with a commitment to hold it till your retirement. Partial withdrawals, of course, are allowed subject to certain conditions. When withdrawing at the age of 60, almost 60% of the money that you take out will be tax-free, and the rest will have to be purchased. You have to use the rest of the money to purchase an annuity. So the idea is to give you some kind of a pension equivalent upon retirement, right? For most of us, this is the only way we will all save up for retirement. So this is something great. The next one is section 80D. This is to promote health insurance, because healthcare in the country is not free. I mean, of course, it is free. You can go to government hospitals, but most of us don't choose to go there. So we buy health insurances and take private care. So you get benefit under section 80D for the health insurance premium that you pay in this format. The maximum you can get is 1 lakh if you are over age 60 and your parents are aged over 60, and you can get 50,000 for the premium that you paid for yourself, and 50,000 for the premium that you pay for your parents, right? And the deduction under section 80D will be 1 lakh. So if individual and family below 60 years, but parents above 60, then for yourself, you'll get 25, for your parents, you'll get 50. If both individual, family and parents are over 60, then for yourself 50, for your parents 50. And if you're a member of the HUF, it's 25-25, and for a non-resident individual, of course, it's 25-25. If parents, this is important for you to understand, if parents age 60 don't have medical insurance for whatever reason, because they've crossed the age limit, or they have some pre-medical conditions, then the medical expenses that you incur on them can be claimed under section 80D up to a maximum of 50,000 per year. Most of us don't make use of this section, but this is the condition, of course, is that your parents don't have a medical insurance, right? Because if your parents have a medical insurance, you've already claimed the premium that you paid. Got it? Great. Then the next one is to promote higher education. So any loan that you take to fund higher education, when I say higher education, simply means any education beyond senior secondary. It can be in India, it can be in abroad, it can be a professional education, can be a vocational education, doesn't matter. And if you're taking a loan for your own higher education, or your spouse's higher education, or your children, or it can be even adopted children, or any student for whom you are the legal guardian, then you get to claim the interest that you pay on this home loan. On this education loan. And this loan should have been taken from a bank or a financial institution or a charitable organization. There is no limit on how much you can make a claim. It's only the interest amount that you can claim, and without any limit. So the total interest paid on the loan without any limit can be claimed for up to 8 years of repayment of the loan. Usually repayment happens after the student completes their education, and they have a 6-month moratorium. And after that, they can repay the loan over 8 years and claim the 80E benefit for the interest that you pay. The last one is, of course, ATG, contribution to social causes. So contribution to select relief funds or charitable institutions. Usually it's the Prime Minister's Relief Fund, and even the COVID Care Fund, PM Care Fund. So, or if there's a national disaster fund. So contribution to these relief funds get you 100% exemption. Then there is a whole list of funds into which you can contribute and get 50% exemption. So you can make these contributions in anything other than cash. And there is a qualifying limit. You can't just earn all your, let's say you're earning 10 lakhs and you say that I gave away all of my 10 lakhs and I will not pay any taxes at all. It doesn't work that way. Your contribution cannot exceed 10% of the gross total income. I mean, your contribution can exceed 10%, doesn't matter, but your tax exemption, you can't claim more than 10% of your gross total income under Section 80G. Contribution to certain donations you can get without qualifying limits. Primarily, they are disaster care relief funds, right? So these are broadly the sections under which you can claim tax deduction. Of course, paying tax is your responsibility. However, saving tax is your right. So you make use of your rights as you fulfill your responsibilities. Okay, so it's another very important thing. Last minute, people are wondering, do you have to do any additional investment for Section 80C at all? So this is the time when you will have your bank RM or your insurance agent or your investment broker coming and telling you 80C ka investments karna hai, ELSS hai, this ULIP is there, this new product has come, but you really need to do anything at all. So let's look at it. You don't have to invest in anything for tax saving if your employer deducts EPF from your salary. So make note of this. If your employer is deducting EPF from your salary, you're repaying a home loan. If you're repaying a home loan, if you're paying premiums for life insurance policies that you already have, if you're paying fees for your children's education in school or college, okay, so what all did I tell you? I told you if your employer deducting EPF from your salary, if you're repaying a home loan, if you're paying premiums for insurance policies that you already have, and if you're paying fees for your children's education in school or college, which I'm presuming most of you all might be doing. And you just add up these amounts, which is how much is the EPF contribution that you're making, how much is the principal repayment on your home loan, how much tuition fees are you paying, right? How much is the premium on your existing insurance policies. And if all of these add up to 1.5 lakhs, you've exhausted the 80C limit. Okay, so every year you don't have to buy new insurance policies to claim 80C benefit. If you already have an insurance policy that you bought last year and you're paying the premium for the same this year as well, the same can be used for claiming 80C benefit. Okay, so you don't have to make any tax saving investment if all of these amounts exceed 1.5 lakhs. But if they don't, then call your financial advisor to find out which is the best option that can give you optimal return and risk with reasonable liquidity and low cost. So check that out. Last minute, be careful. Don't go and dump your money somewhere. Yeah, I'm proud to pay taxes. The only thing is I could be just as proud for half the money. True. So true. Next is 80C options. So let's do a quick comparison of the various options that are available at for 80C deduction. We saw a whole list there. So here I'm just going to take a quick run through on what are the various options, and any investment options, we put them through a few filters. Those filters are how much returns do they give us, what is the risk profile, how much is the lock-in, what is the liquidity structure, do I have to invest every year or is it just a one-time investment, and how will the gains be taxed? Right? So it's not just I make an investment and then when I get the money back, I'm taxed, a lot for it. So let's look at these options. Yeah. So let's look at one option at a time. So the Public Provident Fund gives you a 7.1% risk-free return, and the lock-in period is 15 years. You'll have to pay every year at least 500 rupees, and the gains are also tax-free. So this is brilliant. Only thing is, if you have 15 years for your goals, or if you have 15 years available, you don't need the money, go ahead and invest. Don't do the 500 rupees, it won't make any impact. Invest 50,000, 1 lakh rupees. The maximum you can do of 1.5 lakhs because it all comes under 80C. Then you have the National Savings Certificate, which you can buy from post offices. They give you a 6.8% return, risk-free, of course, and a lock-in period of only 5 years, not 15 years. You don't have to regularly make investment. You can just buy one NSC certificate and hold it for 5 years, and you can claim the benefit for the current year. Right? And the gain or the income, the interest that you earn on your NSC is again tax exempt under Section 80C. So you get the benefit of tax-free income as well. Then there are tax saving FDs. So 5-year tax saving FDs from banks. The returns expected are anywhere between 5% and 7%. They are low risk, can't say risk free. They're low risk. but their lock-in is 5 years. You don't have to make a regular commitment. It doesn't have to be like a recurring deposit. It's a fixed deposit, so you just make it once. And the interest accrued is taxable. It's fully taxable. Usually TDS is deducted on it. Um, so you get benefit at the time of investment, but not your incomes and gains. They are taxable. The next option that you might be considering is ULIPs, unit linked insurance plans. So these are insurance plans that are given out by life insurance companies, and they invest in equity markets. They could invest in debt markets also, but predominantly equity market based ULIPs give you anywhere between 8 to 10% returns. They have a 5-year lock in. They are risky in the sense that they are subject to equity market ups and downs, and you have to make a regular commitment for the ULIPs. There are, both types of policies available. You can make a single premium policy, or you could commit to a regular premium policy. Just that you have to be aware of what you're committing to. So there have been many instances where regular premium policies have been sold as single premium policies. So be very careful to ask this question: do I have to pay premium on this every year, or is it just a one-time thing? Right? And how is the gain tax? Now, this is a new rule for the current year. I mean, it actually effective from the next year, 21-22. But it's important for you to understand this. If the annual premium paid is less than 2.5 lakhs, then all of your gains are tax-free. So it's very possible that your insurance agents are working overdrive to ensure that you invest before 31st March, because you get all your incomes also tax-free. For anything that's invested after 1st of April, if your annual premium is more than 2.5 lakhs, then the gains that you make on whatever you invest more than 2.5 lakhs is not tax-free. They're taxed as capital gains, right? So ULIPs are one thing which have equity market investments, but endowment insurance plans don't invest in equity markets. They just invest in very regular debt-based instruments. So returns expected are 4% to 6%. These are largely insurance LIC policies, or they could be from private insurance companies also. They are risk-free, largely risk-free. They have a lock-in period of at least 5 years. And yes, you might usually have to make a regular annual premium. And the gains and income that are completely tax exempt under Section 1010B. Another option for those of you who have girl children aged less than 10 is the Sukanya Samriddhi Yojana, in which you can invest, but you have to keep investing for 21 years. It's risk-free, of course. You get returns about 7.6%. Of course, this rate can change, just like how your PPF rates. The government comes out with whatever is the rate that their rate of interest that they're going to give for the current year. You have to make a regular commitment to pay on these policies for 21 years, and the gains are tax exempt. So you get tax exemption. 10 is a senior citizen savings scheme. Of course, you should be over 60 years to be investing in this, or you should be over 55 and taken voluntary retirement. So the returns expected are 7.4%, and they are risk-free. They have a minimum lock-in of 5 years, and there is no regular commitment. You just make a one-time investment. And the gains are fully taxable as per the slab. Just like how fixed deposits are fully taxable as per your slab, the senior citizen savings schemes are also fully taxable. Then lastly, of course, is the equity linked savings schemes, which are mutual funds, which can give you anywhere between 12% and 15% return, but they are subject to equity market risks. This is the policy that this is an option that has the lowest lock-in period, so 3 years of lock-in, and you don't have to make a regular commitment. You can, of course, do an SIP or something, but it's not necessary. It's not like an insurance plan that you buy and you have to compulsorily pay, and if you don't pay, the policy will lapse or something like that. No such thing. You want to invest, if you have tax saving requirement for current year, you can invest in the LSS schemes. If you don't have tax saving requirement for the next year, you can skip, right? And the gains are, of course, taxed as capital gains at 10%. Yeah, so these are largely the options that are available for investment. So depending on what your particular situation is, and if you have to necessarily do an ATC investment, if you have 15 years time and you want to be risk free and you're happy with the 7% return, go for a PPF investment, or choose ULIPs if you're okay to take some equity market risks, and stay logged in for 5 years and pay some taxes at the end, or you want the lowest possible lock-in period, and you're okay to take some equity market risks, and you can invest in mutual funds, equity linked savings schemes. So do talk to your financial advisor, your mutual fund distributor, or whoever you work with, and discuss these options available and make a decision. Don't just jump in and do a random investment for tax saving purposes. right? There's nothing wrong with the younger generation that becoming taxpayers won't cure. So tax paying puts you, you know, gives you the right grounding that's necessary for you to grow up. So this was my quick 101 on taxes for the current year. So I'll see you. I hope you become a smart taxpayer and do the right things with your money. Bye bye.